So Ayesha, I think we've broadly been anti-consensus when it comes to the private banks and financials, right? I mean, we have very little exposure there. Everybody likes the private banks. We think that we are better off buying capital market plays than bank stocks, right? And I think what kind of got us thinking was that the financial year 22-23 was a perfect year for banks. You had the best NII, you had the best credit growth, and you had the least credit costs. And despite that, bank stocks didn't deliver, right? And that got us thinking that how come that you have the best of the three variables and still bank stocks refuse to move. And that told you that I think the problem is that, as you rightly mentioned, that on the liability side, it's becoming difficult to raise deposits. And on the asset side, your most profitable segment is credit cards and unsecured lending. That's where the RBI is very uncomfortable if there is significant growth. So your most profitable segment, the RBI is putting the brakes. And on the liability side, you are finding it difficult to raise deposits unless you substantially raise deposit rates, in which case your NIMs will get impacted. So my sense is that, and I believe that, in this cycle, is more for the capital market plays, because you have to follow where the money is. So if the retail household guy is not putting money in deposits and putting money in SIPs or mutual funds, then you are better off buying capital market plays. And I think those have done far better than betting on banks.